Okay, welcome everyone. Good afternoon. We'll start our lesson 2. My name Anjum and is here my email address. If you have any question, drop me email. Today lesson we'll go through LO2, which is about understand working capital. What is meant by working capital, which we'll discuss working capital. Why is it crucial for the company to manage the working capital? And that will go through today lesson. So the last lesson we discuss about different theory about pricing theories. We discuss about Gordon. We discuss about arbitrary prospect theory and a proposed theory. We discuss various theories about the pricing, and we discuss binomial theory as well. So today lesson is all about the working capital. So please you can rate yourself 1 to 10 current knowledge about working capital. How much you know working capital? Especially those people have a accounting background, you learn about current assets. So working capital is known as current assets and current liability. So working capital is known as running capital in the business. So that's day in and day out cash flow. So we need to make sure we have knowledge about working capital, because in a sustainability of the business is a crucial. We have to be managed capital, which is working capital. So current asset mean any asset. What is the definition of asset, guys? Think about asset. Assets is anything we own, anything will bring the economics benefit to for the company, for the business, for the organization. That's called asset. Otherwise it's not asset. Okay, anything you own it which will flow the future economics benefit we call asset. So you can rate yourself how much you know already this, based on this. So today lesson inductive contents, we go through elements of working capital, definition of working capital. We'll go through different types of ownership and sectors. We'll go through a bit discussion about funding, internal external, how we can manage, and different models for the short term management and the long term management we can use, and we'll go through, and some will discuss today lesson. Okay, we'll start. Today lesson we have three inductive contents. Today lesson we have three key command verbs. Is first our assessment criteria. We have 2.1 is explain the nature, element, and importance of working capital in our business organization. Second, we have evaluate. So command verb is evaluate how the business organization assess working capital and funding strategies. And third, analyze how the business organization will manage working capital needs. So these are the crucial things we have to learn, and we have to meet the assessment criteria 2.1, 2.2, and 2.3. So that is crucial. Next, we have, so we'll go through today. So if we look in this one, types of organization. So what we'll go through? We'll go through types of organization. Organization can be private sector organization controlled by the private individual, and public sector organization that controlled by the public sector organization. Then in the private sector can be sole traders, partnership, company, franchise, cooperative. And the public sector can be such as BBC News Broadcaster, which is owned shares by the government. Royal Mail used to be NHS, and then privatization and internationalization is more globalization business. That is growing concept, and that's why we make sure we'll manage different types of organization. Accounting is the way of recording, analyzing, and summarizing the transaction of an entity. So there are the main three profit-making entity. Can be sole trader. The sole trader is or her business is owned by one person, or sole mean individual business. Partnership, it can be two or more, and it can be up to 20 partners in the business. And the partnership in the UK is governed under the Partnership Act 1890. So in limited company is we manage the company, which is a separate legal entity that has own separate name, and the director liability is normally the limited. So owner liability is limited. In case of dissolve the company, nobody asks to claim from your personal assets. So limited companies owned by the shareholders and managed by directors, and the company itself is a separate legal entity. Then we can look around different types of organization. Not for the profit entities can be charities, clubs, societies, non-governmental organization, NGOs. Then we have a charities regulated nationally by the Charities Commission, and they also prepare these statement of financial position, statement of financial activities, and annual reports to the Charity Commission, and sometime income and expenditure account and statement recommended practices, and in all other countries we have to follow the local legislation. So limited liabilities have own advantages and disadvantages as well. Owner, shareholder, large managed profit, they can split into the shareholders. It can be private limited and the public limited company. Okay, then partnership has own advantages. Of course, the diverse is a different experience, different people have. Sometimes the problem of conflict, sometimes the controlling issues, resolution, partners can come in and join and leave, that can be issues. So Companies Act, which is managed and controlled by the Companies Act 2006 in the UK. Companies information should be in the financial statement, true and fair, and it's managed under the Company Act 2006. Anybody any question, please? You can think, or you can drop me email. You can ask from me. Okay, next please. We're looking limited liability partnership. So if we have a business is a partnership, you people coming together and start a business, that's a partnership. But partnership business can be registered as a limited liability partnership. So it means whatever you invested as together, nobody can claim from your personal asset, and you registered limited liability partnership in the company house. It's a sort of company, but is a partner, your private investor on the company itself. Okay, and we file the account in the company house. Then, okay, different sectors according to the size, according to the local, national, international. It can be primary sector where we raw material, we can explore like mining industries, like coal industries, like various other agriculture. These are the primary sector. Then we have a secondary sector is which is manufacturing, which is very less in the UK. That's a secondary sector, especially China is rich in the secondary sector. Then third is a tertiary sector, which is a service sector, which is a huge in the UK. Around 60% national income is generated by the services like college, institution, chartered institute, like one of our which we're doing OTHM level 5 course, grouping them following the most practical, private, public, voluntary, and the charities. Okay, then working capital is the capital receivable by conducting day-to-day operation of an organization, normally the excess of current asset over current liability. So working capital management is the management of all assets, all aspects of both current asset and current liability to minimize the risk of insolvency while maximizing the return on the asset. So current asset is a major financial position statement which show the current asset mismanagement of the working capital, therefore common cause of the business failure. So that's why is need to be inability to meet the bills, fall due, demand of the cash during the period of the growth, being greater overtrading. You have lot of overtrade, credit sales, there is no cash. Overstocking, you bought too much stock, but don't have a cash now to meet your current expenses. expenditure. So that is working capital management is a key factor in organization long-term success. So inventory, receivable, cash and bank, current asset, required funding, consider, reducing level. So difference working capital, so trade and the bank overdraft, we can think about, and the current liabilities can be providing funding to cover increasing level of cash. Okay, then the decision regarding the level of overall investment in the working capital, cost and benefit analysis and trade-off, liquidity versus the profitability that we can do, and we want to be make sure we'll just carry on following. Okay, anybody any question? Okay, that's we can look around. Okay, that's we need to be make sure we manage these, and that is a crucial thing. So what we need to do, unprofitable companies can survive if the liquid profitability company can fail, so they can run out the cash, and they, of course, the liabilities, wages and amount dues and other dues, and the liquidity in the context of the working capital management, having enough cash to ready to accept the cash to meet and the payment obligation and fall. The cash at bank, cash short-term investment, inflows from the normal trading operations, overdraft facilities, how we can generate the cash. Okay, that's we need to be look around. The Working Capital Balance Act is ensuring the current assets are the sufficient. Okay, let's please, we'll go through. So we just want to be make sure. Okay, so ensure the current assets are the sufficient, the liquid to the minimize the risk of solvency, liquidity, investing in the less liquid asset in order to maximize the return. So there is a liquidity and the profitability we need to be make sure we balance, balancing act. Okay, next now. Okay, element of working capital, managing the working capital involve. Hello. So next, we're looking the working capital management. Hello, can you hear me? Welcome.
Hello.
Hello, welcome. So today I already started the session, so just from a recording as well, so I can recap quicker. So today lesson is about the working capital. We discuss about types of ownership, public limited, private limited. We discuss about sole trader partnership, which I already recorded, limited companies, and public and private sector companies. Yes. Today lesson we have three assessment criteria explained. Is all about the working capital. Yes, working capital means short-term asset, current asset, and we have to be managed. How we can manage that we are discussing today lesson. That's the key in different organization, and we need a balanced approach. So now we are discussing element of working capital. So working capital involve the managing individual elements is inventory, which is stock. How many days we have a stock? Stock always, we heard about JIT, just in time. Maybe you learn about economics order quantity. We need only buy what you need it, not too much stock. Like, people buy things, ultimately they're running out the cash and they're struggling. And the same thing has happened in the business world as well, especially in UK, New Year Boxing Sale, people buy a lot of discount, but ultimately maybe they're buying too much stuff using credit card and then struggling to pay off. So same thing in a business world, we need to be maintain well working capital, so that will help to meet our running expenses. So debtor payables and the creditors, we need to be managed cash. So funding strategy in same ways, long-term investment firm must make the decision about what sources of finance best to be meet the short-term. So short-term, normally we can use overdraft, we can use the invoice discounting if you have a different invoice, debtors management and creditors management. That is a crucial, that will help to be manage our funds. And the risk in the short-term financing, of course, is normally is a high cost. If you go through the payday lender or you use overdraft, normally is a high interest rate or per day fees involved if you don't have an overdraft arrangement in place. Attitude of management toward the risk always, is really crucial. Attitude to the little thing but make you different. Any question?
No, it's clear. Okay.
Okay, brilliant. Next, we're looking the permanent or the fluctuating. Assets, current asset always fluctuate. That's why within a 12 months that carry on going up and down. So buffer stock like a safety level, maintain always, we not run out the inventory. Receivable during the credit period, we can minimum cash balance. If too much cash you have in the bank account, that's not good as well, because you can invest, you can multiply your cash, you can earn profit out of it. So short-term finance and the long or the shortfalls can be permanent current asset and the non-current asset. Non-current asset mean the long term. Here we're looking the short term. The choice of the finance permanent current assets is matter for the managerial judgment and includes the analysis of the cost and the risk for this short-term finance. The attitude of the management towards risk and aggressive and conservative matching funding policies. So always good to be look around what will be the sources of finance, where you get the money from. It's good to be you ask, give discount to the people, to your customer to whom you're supposed to be receive money. They can pay early and we can save money. Aggressive financing, most of the current asset, including permanent one, which is short-term finance, is a risky but the profitable. Conservative long-term finance is used most current asset, including the proportion of the fluctuating current assets. So stable but expensive. So this can be more risky but profitable. This can be stable but expensive, and matching the duration of finance is matched with the duration of investment. and the firm choose add to the lower level of working capital, then revolver is set the aggressive approach where the firm with the high level of working capital as a conservative approach. Okay, so an aggressive approach will be result higher profitability and higher risk. High risk and while the conservative will be result in the lower profit and lower risk. So it's whichever approach you will use. It's entirely up to you. Like we said yesterday, don't put all your egg in one basket. You look different sources of funds. So our capitalization, sometime you saying buy now and pay in 5 years. Like we have a company called DFF sofas in UK. So they normally say buy now your sofas and you can pay in 5 years. That's our trading. You do a lot of trade, but ultimately you don't have a cash. Cash is a lifeblood of thriving business. So effective and efficient management of working capital is essential to maintain control of the business cash flows. So the business, the management must have a full awareness of profitability versus liquidity trade-off. Yes. So it's not profit will come after. You have a profit, but you don't have a cash because you're selling everything on credit. Profit is not a cash. Profit is can be credit sales as well. So for example, healthy trading growth typical produce and increasing profitability. The need to increase the investment in the non-current asset and working. In contrast to the overcapitalization, the business does not have access sufficient fund to increase. Any question here?
No, thank you.
Okay. Then we're looking the cash operating cycle. We need to look around what is include. Cash payment to supplier. Always you make sure you pay late, like in 60 days. And you buy the raw material only you need it. You process the raw material and convert into the finished goods quick. You sell to the customer but try to be receive money in less than 30 days. So if you're paying 60 days to supplier, 30 days you receive from customer. So at least you have a 30 days safety net. You have a cash for 30 days. Yes. So because at the moment is a big problem with the companies is due to the COVID-19, the business closed, and still they have to pay the salary to the staff and the money not coming. They have asset, they have property, plant in £1 million worth of, but they don't have a cash. So that can be a big problem. The faster firm can push the item around the cycle, the lower will be investment working capital. So that's we need to be make sure we'll manage it. Okay, then next we have a different formulas we can use to calculate cash operating cycle. We can look around raw material holding period, how long you hold the material, less the payable payment period, work in progress holding period, which is how long work in progress of inventory, then finished goods holding period, and receivable collection period. So that make the manufacturing, and this is called cash operating cycle. We can calculate through this. For wholesale and the retailer businesses, there will be a no raw material or work in progress holding cycle. To simplify, what we can do, the cycle may be used days or weeks or the month holding period of inventory. So inventory holding periods less the payment made to the supplier and less the add the receivable, and that give you this ratio which we call yes cycle, and we can calculate it. Any question?
No.
Okay. The factor that affecting the operating cycle length of the cycle depend liquidity versus profitability. Yes, think about if you invest in oil, you discover oil, it takes ages, and then you sell in the market. But if you invest in buying food and food drinks, quickly people will buy it, and you can earn it, or in the fashion industry. So, but it's maybe not forever, not too much, but we need to think about short term and the long term. Term of the yes. So, any question? Sorry.
No.
Okay, management of efficiency, how efficient you are to managing things. Identify norms, retailer, construction, and all industry. You need to be idle cash, unused inventory. If your inventory warehouse laying down can be obsolete, can be outdated. So you have a lot of clothes in your locker, almaris, whatever. Yes. So what is this? Is a waste of money because that's your resources, and when you need cash, you don't have a cash. So we need to be make sure we have the things only what we needed. So inventory is a holding period. We need to be how long we are hold the inventory. Always good to be less holding period because you can convert inventory into the cash. So if we want to calculate, we can in the statement of financial position, which also known as balance sheet, we can look around the inventory divided by the cost of sales, which we can find from the profit and loss, and times by 365, we can calculate, the holding periods. Okay, raw material inventories, these are the formulas which we can use. Yes, time allowed minus time taken divided by 2. So purchase and being sold raw material are being converted into the, yes. So how long will took? A whole working in progress inventory divided by production cost times by 365. So we can calculate finished goods inventory divided by the cost of sale times by 365. So we can calculate days and the times, how long which convert into the finished goods. So this is all from these are the all formula in especially in manufacturing industries we can use it because they have a work in progress. But other we buying and selling finished goods, then we have just finished goods. Any question?
No.
Okay, trade receivable. Trade receivable mean the money the goods we sell on credit to our customer, and we always look, how long the receivable, how much we have divided by the cost of sale, divided by the credit sale, how much we sold, time by 365 days. So we can find how many days we have a receivable, then we can calculate how many days we have a payable. So number of levers who require the replacement, average number of employees, we can calculate these, per employees and per. Okay, then we next looking the working capital liquidity ratio. These are quite good to be look around. We have a current ratio divided by current asset divided by current liabilities. Normally it need to be 2 to 1, which is if you have, which is really good. If you don't have, maybe it varies industry to industry. You have to make sure you look around. In the industry what is average. Quick ratios mean the inventory sometime is not liquid. You take out inventory and you just do like this, current asset minus inventory divided by current. This is normally benchmark as 1 to 1, and we can compare in with the industry average. It's not a hard and fast rule, but that's most of analysts says if you have £1 worth of asset, you have £1 worth of liability. Okay, then the working capital turnover. Working capital turnover mean how quick your asset convert into the finished goods, sell it and convert into the cash. So that's you have. We need to be make sure we'll keep it. So trade receivable day divided by 365 times by credit sales, and we can find trade receivable balance. Any question?
No. It's clear.
Okay, next we have a cash and the funding strategies. We can look around the reason for the holding cash. We can look around the short term and borrowing cash budget. We can make it in and out. We always make the cash management model different. We can use Bummel and Miller model, which we'll go through the following lesson more in detail. And funding working capital, where we can fund short term and strategies we can use. What I did, I copied the link for you, especially this link is Kaplan. Kaplan is one of the biggest publishers, especially the financial documents and these financial theories and financial books. So I'll share with you, we can read this, which is quite good to be. So this is working capital. So we can look around the reason for holding cash. We have a transaction motive, we have a saving motive, or we have an investment motive. Then reason for holding cash. Then the cash balancing act, we should have cash budget we can prepare, and we can look around which month how much cash in and out from the business. And then we have additional, there are the questions, yes, about the cash in which month how much we have, and we can calculate. These are all different examples good to be go through. and then we have a 0. So number of the cost of the input, expected output, the average cost, how much will cost us. Working capital ratios we can calculate, like we discuss about those ratios. We have a different question if you want to embed in any example. How we can manage treasury department, like debt capacity, currencies issues, foreign currencies, dividend policies, all help, so we need to look around. This is the economics order quantity formula to CO. Yes, so we can look around how much is economically is viable to buy and stock. This is the Miller model, and the Miller is control irregular movement of the cash upper end. So we can set the limit, and we can say this is the line. Yes, we want to not maximum, not minimum. So there can be sometime it's go up and down according to the Miller, and we need to be managed. Yes, and we can use Miller model. Then we been given next model is this is short term, long term liquidity. Yes, thus we can manage risk and reward. If you have high risk, so high, like we discuss about conservative approach, and these we can calculate as well, like we discuss buffer stock. Now we can apply into numerical formulas. So this is all about, and all these models we can use Miller and yes. Any question?
Mm-hmm.
And we discuss about
No.
all. Yes, so this is the equation we can use it, how we can manage the stock.
Okay.
So this is quite good to be read background, and when we'll prepare assignment, so we can add some example from this further reading as well.
All right. Okay.
Okay, and I copied one other website as well, quite good to be, which is tutor2u.net, and the link you can copy and you can further read as well. That's a readable document, and it's good to be read to enhance your understanding. So we'll keep up to here. Today lesson we discuss about working capital, we discuss about types of ownership, sole traded partnership, limited company, public and private sector organization. So we'll keep up to here. And if you have any questions, feel free, please drop me email, and I'll try my best to get back to you as soon as possible. Thanks for listening and attending, and hope so the next lesson will go through LO3, and hope so I'll speak to you all during our next lesson. Thank you. Bye-bye.